to get into this oil. So the price of oil, I looked this morning, and that's why I told you, Jackie, it's $95 a barrel. And you go to something called WTI, and that's the world price of oil. We predicted that last year that the oil price would be at about $90 a barrel based on the supply and demand. You have a huge demand for oil, obviously, right? And you know, oil has a limited supply, regardless of what you think. And I know this personally, oil will deplete as you drill the hole. It's not an endless supply. So you have to keep drilling new locations. I have a lot of experience with this because I've personally been involved in this before with my own money. It's extremely risky. It's very interesting. But I'll talk a little bit more about it. But we predicted that the price of oil would be around $90 a barrel. Now, this war and this shutting down of the Strait of Hormuz is the reason. Did I say that right? Strait of Hormuz? Hormuz, okay. We shut it down, and now we're being a little bit more flexible. But what I saw this morning was they're obviously waiting to finalize this negotiation, which means that, you know, Iran should never have a nuclear weapon or ever have the opportunity to build one again. And I don't know what's going on about that, and I'm not going to get into politics. What I'm going to say, though, is if you think about oil and the price of that oil being $95 a barrel, every single consumer product that you use, or at least most of them, okay? So I don't want people sending me these, you know, emails or text messages saying, Bruce, you were wrong about this. It's not
anything
in every
plastic.
Product, you know.
Anything plastic.
So many things use oil. Cosmetics, plastics, so many things. That's obviously going to drive the price. You think about any product you have to ship it, whether it's in a plane or it's in a truck or it's on a ship. So oil affects consumer spending. And when oil prices are high like this, it's going to affect it. Now, how long is this going to last? Your guess is as good as mine. But folks, what I can tell you is this. I think it's going to settle around $55 to $65 a barrel, okay? I think we're going to be in that $3 to $3.50 a gallon rate. Now, that's what I think. Does that mean that it's going to happen? I mean, nobody has a crystal ball, but I don't think this is a long-term problem. I think it's a short-term problem, but it doesn't necessarily solve the problem that the price of oil should be higher because we have a demand for it. And it's not just cars, and it's not just airplanes. It's a lot of things. And that's what people have to understand. So like people that don't believe in, you know, drilling for oil, it's going to ruin the land and so forth. And I can tell you that from drilling oil, there is so many things that you have to get to drill oil. Bonds, insurance, like what if you have a spill? You have to have these things in place, otherwise you can't drill. And what I can tell you is that even if you build windmills, you're still going to need oil inside of that engine that turns the windmill.
Yes.
And if you don't have it lubricating that, it's going to freeze. So it's not going to, the supply is going to always diminish. The demand is always going to be there for the next hundreds of years. And think about it, it's almost impossible to get off of it. Let's take it one step further. You look at the prices of electricity. If you shut down cars with gasoline and you put the demand on cars with electricity, okay, how do you think electricity comes out of the ground or comes out of the air, the plant? It's not out of the ground. Obviously, oil's out of the ground. How do you think it comes out of? There's turbines, right? What do you power turbines with? Natural gas. You have to then
water. Yes.
Mostly natural gas, because I have some guys that work at APS and SRP that are clients of mine, and they're actually the managers of these facilities in certain turbines. These big, huge turbines, and you have to clean them all the time, and they're powered by natural gas. Natural gas is so much more detrimental to the environment than drilling certain ways for oil. Like there are all different ways to drill. You could do what's called wildcatting, which is not good for the environment, or you could do fracking, which that's what they do for natural gas, which basically you're drilling sideways and you're wildcatting. You're just going in there and you're pulling out natural gas because it's in between certain structures. Whereas if you drill vertically in the ground, you're drilling to a certain spot. You're trying to hit it at the top of the structure to pull it out. And so what does this do for me and my retirement plans? Well, number one, if your advisor told you that you should be diversified, let's just say in maybe some energy type of stocks, you probably would have done okay, because if you buy it now, I'm not sure how long this is going to last for. When you buy a stock or a mutual fund, you want to make sure you know what you're buying. You want to make sure it's valued properly. We buy a lot of individual securities. I'm not going to tell you what we do. You're going to be able to call in and talk to me about that. But what the most important thing is that you always should have certain classes of where you invest in. Otherwise, what happens is you miss out on some opportunity. And what people tend to do is to buy high and sell low. You want to have a structured plan. You want to have it rebalanced, and you want to make sure that someone's keeping an eye on this if you don't have an advisor and the money is in an IRA or some other account per se. So it's very important that you understand that oil is in everything that we use, and it's going to affect certain consumer staples more than others. And so what you want to do is you want to take advantage of these things today and think about things that could be in the future, in the near future, that would probably end up doing better if that company is in that type of business, whatever the business would be, because the prices they're going to have to drive are going to have to increase in order to sustain the cost of what it's costing them to get the product to their door. Okay. So I think people should really take a step backwards. And if you're an analytical and you want opportunity, take this time instead of saying, I wish I would have or should have or I could have. I wish I would have been in that before this happened, and take advantage of situations when they happen. For example, another example outside of oil and gas. Okay. How about technology? We have seen a decrease in the prices of Microsoft, for example. Alphabet, which is Google, to the point where I told you on the radio, and we had a conversation about this many, many months ago, and I said to people, you're going to see a decrease in your account in the very near future because technology is overvalued and it can't continue to be at this price. So it's a good time to sell and re-diversify, right? Yes. Well, what happens also is in mutual funds, a lot of the money managers that manage these funds will buy a lot of positions in technology to drive the returns of these funds. That's what they're getting paid to do. It's all about how much can you make me today, you know? And so one of the important things that it is to do is to always have asset allocation inside your portfolios, which is mostly your 401k. Most of the people that come in have most of their assets in their 401k. Diversify it. If there's an opportunity to own energy, maybe it's okay to put 5% in there or 10% in there. You don't put 100% in there. You already missed a good chunk of the increase in precious metals, which there are a lot of that inside of 401ks. A lot of times you'll have that. But I know there's natural resource funds in 401ks because I've sold 401ks. I still have quite a few of them in place. So, you talk to us.
Premier Southwest Planning Group, LLC is a registered investment advisor. The content of this advertisement is intended for informational purposes only and is not intended to be investment advice. The views expressed in this program are subject to change based on market and other conditions.